We have something pretty interesting that's happening in the stock market today. The stock market is going down, but mainly the financial stocks and specifically the bank stocks. Like, for example, JP Morgan is down 5.5%. Bank of America is down 6%. Wells Fargo is down, 6%. Many other tech stocks are finally starting to go down. The fundamentals and the technicals are finally starting to align together. But this is mainly because of SVB, which is Silicone Valley Bank, ticker symbol SIVB. And the stock is down over 60% just today due to many reasons which we're going to talk about. But normally, whenever we have such big moves in the market, you have a lot of people on Twitter, like for example, I'm starting to see charts claiming that the S&P is going to 2200, and you start having a lot of drama on YouTube and people calling for a 2008 financial crisis, which again could potentially be it. This may be it today. Maybe this is the trigger that we've been talking about for months and months on the channel, saying that the market is going up and is basically lagging a catalyst for it to come crashing down so we can actually bottom on very good fundamentals. But maybe this is also not it, which is why I believe we have to be rational and try to assess the situation best without any drama or any, doom and gloom type of stuff, to try to, again, determine the likelihood of this maybe is the start of something like another 2008, or maybe this is just, some type of noise that within the next few days or a few weeks, people will pretty much, forget about. Just like if you will remember, Credit Suisse a couple of months ago, people were claiming that Credit Suisse is it, this is going to be the end or whatever, and the stock market still rallied on that, and so far nothing has pretty much happened. So again, we're going to take a look at that and assess the situation. Now, to really begin with what's really happening with Silicon Valley Bank, someone actually did a pretty amazing thread on it on Twitter, and this person put a lot of research. So I would like to go over that today before I assess the likelihood of this actually being some type of the next 2008. Now, this is Silicon Valley Bank, and the main reason, again, it's going down that much is they announced a fire sale of their $21 billion asset for sale portfolio, and pretty much they sold it at a $1.8 billion loss on sale because they did a fire sale. They had to sell it very, very fast, and this is normally happen whenever they need a lot of liquidity. They try to get rid of something that's very, very fast, and they lost $1.8 billion, which is actually more than $1.5 billion of their own net income. So they lost more than actual net income than what they made in 2021. This is one of the first reasons this has happened. But why has it actually happened? Why did they have such a loss? Why did they have so much trouble? Because they were positioned very, very bad before we had the interest rates actually increasing. The company's $21 billion bond portfolio had a yield of an only 1.79% and a duration of 3.6 years, which doesn't even compare with the 3-year treasury or 4.71%. So they were very bad positioned, and this is Silicon Valley Bank's own personal problem. That doesn't mean Bank of America has the same thing. That doesn't mean JP Morgan has the same thing. Although it could be possible that they have such, things happening, but in my personal opinion, it's more around the regional banks than actually, the big banks with this whole thing, although they could, still be exposed. But something else that's happening within Silicon Valley Bank is it's actually a pretty popular bank in terms of the tech stocks, a lot of the hype stuff, and, the IPOs and the SPACs. They were pretty popular, in 1999 and the 2000s when they had a lot of warrants on those tech bubble stocks, and then their stock pretty much skyrocketed, after that. And a lot of people were investing in Silicon Valley Bank to actually get exposure, to the growth stocks and a lot of the internet stocks of the bubbles that we had in 1999 and 2000s. And they are still very exposed to pretty much tech. And this is the number of IPOs they pretty much dumped to 181 in 2022, and we don't have all the SPACs that we had, before the Fed pretty much popped the bubble when they started hiking rates, and this has left the company in a pretty vulnerable position. Now, looking at what's really happening today, and this is two things that we have to really look at for us to assess the situation and determine if this is really, some type of a liquidity event or this is just, short-term noise. And the first one is actually high yield yield corporate bonds, which is HYG. Normally, whenever you have some type of a credit event, people try to get rid of the junk stuff first, and this is one of those stuff, the high yield corporate bonds, where they try to get rid of it first, and this is again down today 55 basis points, which is again a pretty decent move for a ETF like HYG. But if this was really such a big deal and the start of a liquidity event, I would personally prefer to see maybe down 1 or 2%, like something pretty scary. But we haven't seen that today so far. Something else which pretty much no one on Twitter is talking about is actually gold. Now, gold again is a safe haven, is the flight to safety, but not when we have a liquidity event. Whenever we have a liquidity event, people sell gold to try to cover their debt, to try to do a lot of that stuff, which is why it goes down always first in such crises like we had in 2008, like we had in March 2020, and it always recovers and makes a new high before stocks actually do that. But again, gold is up 91 basis points today. It's not down, which again really tends to tell me that maybe this is not, some type of a liquidity event like many people are claiming. Now, maybe this will reverse tomorrow and something will change, but so far I am not seeing the characteristics of such of a liquidity event. It could be an overreaction within the bank stocks. And remind you, I am personally bearish on the stock market, and I've been making bearish videos since pretty much 2021, but I'm trying to be rational with the situation, and so far I have not seen any signs that would make me want to do, doom and gloom videos and claim that this is another 2008. Now, something else that I'm looking at is the 10-year minus the 2-year. And again, this is not a rule of thumb, but normally we have something that actually breaks whenever, this whole thing flips positive, like what happened in 2000, what happened in 2008, what happened, around 2007, and then it also happened in August of 2019. So we normally have the real pain after, the 10-year minus the 2-year actually goes from inverted negative and it actually goes positive. And we could not be further away from that. Now, that doesn't mean that something bad can't happen while it's negative, but I'm trying to assess the odds and the likelihood of this actually being, something pretty bad. And nothing is pretty much lining up in terms of gold going up, in terms of high yield bonds. They are actually selling off, but I would prefer to see them sell off a little bit more than what I'm saying, today. And again, looking at gold and looking at the 10-year. And looking at the S&P 500 itself, I have been talking about the 3950 level, that this is a critical level that we have to close below. And again, it's happening today. It's pretty much around 25 minutes for the close, and we are around 3926. And maybe again, the market is finally starting to line up with the fundamentals. But looking at a basic technical picture, we are still above the trend line. We have not gone back below the channel, which again, what normally means in terms of the algorithm and in terms of the things that really trigger sell-offs and it triggers short positions, that the bear market is really, not back. We're not back in the channel. We're not back to where we were, before. So again, as someone that's actually bearish on the fundamentals of the market, I'm trying to assess everything that happened today. And maybe it will all change tomorrow. Maybe everything will start selling off. Maybe we'll see, HYG down, 1.5 or 1 or 2%. Maybe we'll see gold starting to go down because, there's liquidity issues and some other bank are selling gold. So we're going to find out what really happens in the next few weeks. But from me trying to assess this whole situation, I want the stock market to go down. And I wouldn't mind the stock market going down. But from me, again, looking at everything, looking at, what's happening, I don't see another, 2008 financial crisis actually, happening right now. Although I could be wrong, but we're going to reassess the situation, whenever we have more information on that stuff. So this was my opinion on what's happening today in the market, and I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.